Welcome to Colibri Real Estate, transforming lives one home at a time. I'm Cami Jelinek. Today we're going to dive into the topic of doc stamps, which are crucial for understanding the cost associated with real estate transactions. Let's break it down step by step. When we talk about doc stamps, we're referring to the three different taxes. The acronym we use to remember these taxes is SIN, because nobody likes to pay them. Here's a quick way to remember who pays which. S is state documentary stamp tax on the deed paid by the seller. I is intangible tax paid by the buyer, and N is note tax, also paid by the buyer. Let's dive into the details of each tax. The state documentary stamp tax on the deed is paid on the actual sales price of the property. The rate is 70 cents per $100 or fraction thereof. This tax is paid by the seller. The intangible tax is paid on new mortgages. The rate is 2 mils, which is 0.002 times the new mortgage amount. This tax is paid by the buyer. The note tax is paid on new or assumed notes. The rate is 35 cents per $100 or fraction thereof. This tax is also paid by the buyer. If a property is purchased subject to a mortgage, there would be no new note created and therefore no note tax. Let's take a look at a question. It says you're reviewing a closing disclosure and you note that the document stamp tax on the deed was $2,800 and the stamp tax on the promissory note was $1,120. What is the loan to value ratio on this transaction? To calculate the loan to value ratio, we need to know the loan amount and the sales price. The sales price can be found by reversing the doc stamp tax calculation. So sales price would be $2,800 divided by 70 cents times 100 equaling $400,000. For the note tax, the loan amount would be $1,120 divided by 35 cents times 100, which equals $320,000. Now we calculate the loan to value ratio by taking $320,000 and dividing it by $400,000, which gives us 80%. Next question. A property sold for $310,010. The buyer assumed the balance of the seller's loan of $250,000 and received a purchase money mortgage of $10,000 from the seller. What are the total state documentary stamp taxes on the deed? So to answer this, we only need to calculate the state documentary stamp tax on the deed. We will take the sales price of $310,010 and divide that by 100, which equals $3,110, which we will round up to $3,101. To find the tax amount, we will take the $3,101 times 70 cents, which equals $2,170.70. So the state doc stamp tax on the deed is $2,170.70. Let's take this one step further. Suppose the sales price was $280,210, subject to a mortgage of $220,000, an assumed mortgage of $20,260, and a purchase money mortgage of $10,520. How do we calculate all the taxes? First, the state documentary stamp tax on the deed shows the sales price of $280,210. We divide that by 100 to find $2,802.10, which we're going to round to $2,803. Then for the tax amount, we're going to take the $2,803 and times that by 70 cents, which will give us $1,962.10. Next, the intangible tax on the new mortgage, which we will find by taking $10,520 times 0.002, which equals $21.04. Finally, the note tax on the new and assumed mortgages. We'll take the purchase money mortgage amount of $10,520 and divide that by 100 to give us $105.20, which we then round up to $106. For the tax amount, we will take the $106 times 35 cents, which will give us $37.10. For the assumed mortgage, we will take the amount of $20,260 divided by 100 equals $202.60, which we will then round up to $203. For the tax amount, we will take the $203 times 35 cents, which equals $71.05. We will then add all of these together for the total taxes due. Final question. A vacant parcel of land is located in the northeast quarter of the southwest quarter of the northwest quarter of the southwest quarter of Section 17, Township 18 South, Range 4 West. The land is selling for $15 per square foot, so calculate the state dock stamp tax on the deed. First, calculate the size of the property. The section size is 640 acres, so we're going to divide 640 acres by 4 times, which equals 2.5 acres. To find the square footage, we will take the 2.5 acres and times that by 43,560, which equals 108,900 square feet. Next, calculate the sales price. So we take 108,900 times $15, which equals 1,633,500. Finally, calculate the dock stamp tax by taking 1,633,500 divided by 100, which gives us 16,335. For the tax amount, we take the 16,335 times 70 cents, which will equal $11,434.50. So the state dock stamp tax on the deed will read $11,434.50. Understanding dock stamps is crucial for accurately calculating the cost associated with real estate transactions. Always double check your calculations and make sure you're answering the specific question asked. That's it for today's session on dock stamps. I hope this helps you understand how to approach these questions. Thanks for watching, and if you found this video helpful, don't forget to hit the like button and subscribe to Colibri Real Estate channel for more tips and tricks. Good luck and see you in the next one.